Well, when I stood here in this delightful garden 5 weeks ago and gave you our forecast for growth in 2020 and our unemployment profile and our budget position, which would dictate the level of government bond issuance, we were really working off a blank piece of paper, aware that the economy was going to go through extraordinary turmoil. The forecasts that we released on that day were that the economy would contract by 5% over the course of 2020. In the first half of the year, it would contract by nearly 9.5%. The unemployment rate would reach 9% by the end of June, down to a bit over 7% by the end of December 2020. And in 2021, growth would slow to around 4%, and the unemployment rate would stay between that 6 and 7% range. We also indicated that because of the increase in cost of the stimulus package, which was represented by the first two phases of packages, but also the culminating in $130 billion of the JobKeepers package, plus the impact that the cyclical deficit would have on the budget with bigger unemployment benefits, less corporate taxes, etc. We thought that the budget would require the issuance of $310 billion in bonds over the course of 2 years. Well, over that 5-week period, the picture has become clearer. Particularly, we've benefited from the release of the Westpac Consumer Sentiment Index and also a number of special releases that the Australian Bureau of Statistics has created for us, looking at employment, looking at consumer, at the household sector, and looking at business. We saw today that that retail sales for the month of March were up by 8.5%. That was dominated by over 20% lift in spending on food, the so-called panic stockpiling. But other information that we've seen around that June quarter is obviously extraordinarily concerning. So we saw today that motor vehicle registrations are down nearly 50% for the month of April. Credit card and credit bureau data is indicating that spending on services is down around 40%. Our consumer sentiment index was down by 17.7% in the month of April. And of course, time to buy a major household item was down by a record 33%. So all of that data is giving us comfort that our minus 9.5% for the first half of the year and 8.5% of that in the second quarter is likely to occur, and we're still happy with our 13% contraction in consumer spending in the second quarter. We've also seen the Bureau of Statistics release employment data. So we saw a 7.5% fall in the number of jobs between mid-March and mid-April. That's an extraordinary number, and that's more than around 900,000 jobs lost. We've only estimated that in the whole of the June quarter, we'd lose about 500,000 jobs. But bear in mind, before the introduction of JobKeeper, we expected that loss to be 1.2 million. So we're still comfortable that we think that when the April jobs report is released in a couple of weeks' time, that it will register a loss of 350,000 jobs, about half the number that was shown up in this survey. We think there's a JobKeeper effect there. We think that earlier survey counts the number of jobs lost rather than individuals. And of course, many individuals have more than one job or did have more than one job. We think there's other measurement issues. So we're still comfortable to be on track for that around 9% rise in the unemployment rate by the middle of the year, and that 7% story by the end of the year. Bear in mind that the official family has also released some numbers around growth and unemployment. So the Reserve Bank indicated they expected growth to contract by 6% this year compared to our 5%, that the first half of the year would be a minus 10 compared to our minus 9.5%, and that the unemployment rate would reach 10% by the end of June compared to our 9%. So we feel that we're pretty well in the ballpark, particularly happy that we produced these forecasts almost 4 weeks before we saw the Reserve Bank's forecast. Reserve Bank will give us a lot more colour on their forecast in the Statement on Monetary Policy that's delivered on Friday. Other reports that the Bureau of Statistics release, which are very interesting, are around business confidence. So not surprisingly, around 70% of respondents are concerned about their cash flow and their demand conditions, but 44% are worried about financial markets, with a particular emphasis on the Australian dollar. The good news is that only 24% are concerned about the availability of credit. So when we look at this compared to, say, the global financial crisis, where the credit crunch was the key factor behind businesses' problems, this time it's more around demand, and we know that government policy will eventually evolve to restore a lot of that demand. We also receive information around the housing market. And as I indicated, I expect that house prices will fall by around 10% from this point to the end of the year, another 5% next year. We were shocked in the April Consumer Sentiment Survey, where we saw a 50% reduction in respondents' assessment of the outlook for house prices, which was obviously a huge record. And we also saw a 26% reduction in the question, is now a good time to buy a house? That's the worst result we've seen in 47 years of the survey. So that set the scene for a lack of confidence in housing. Our sentiment survey also, we can use the data to assess what's likely to happen to turnover in housing market. We think that's going to be down around 40%. But it's only a 10% fall that I'm talking about, because households will not be under too much pressure. We know the banks have given them an interest rate holiday. Interest rates anyway are extraordinarily low. And so I expect that there won't be a lot of panic selling into this market. Some investors may decide to sell on the basis that they've made decent profits on their housing asset, and they need to offset that against losses that they've made in the equity market. So broadly speaking, we do see weakness in the housing market, but a 10% fall rather than some of those bigger numbers that we've seen released by others. One really concerning development has been the Prime Minister's statement that he expected immigration to fall by 85% over the next year. That will have an impact upon confidence in housing. It'll have an impact on underlying growth, and would certainly make us think clearly about whether the economy can grow by 4% next year if we were to see that sort of extreme response to immigration. We're feeling relatively comfortable in this really uncertain period with our forecasts that we released 5 weeks ago. Obviously, to have the official family very much in line with our own views is helpful. And the data that we've seen over the last 5 weeks certainly point in the sort of direction that relates to our forecasts. We're mindful of the fact that business is concerned about financial markets, and we expect that the Australian dollar will fall back to 62 cents by June before lifting sustainably over the next 18 months to around 70 cents by the end of 2021. And all of this, of course, is predicated by our starting point, which has been our view on the way in which the Australian economy will evolve with respect to the virus. So our starting point has always been that there'd be very modest unwinding of shutdowns in the June quarter. There would be regular unwindings in the September quarter, and by the December quarter, the constraints would be international travel and social distancing, but most of the other shutdown effects will have passed. That's the model that we're using, and having seen Australia's success over the last month or so, we may be a little cautious in that model, but I feel more comfortable to have the cautious position than to predict too early an unwinding of a lot of the shutdowns. Thank you.